$4.2 trillion. That isn't a budget. That isn't the GDP of a small nation. That is the blast radius. That is the aggregate value of commercial and residential real estate debt maturing within the next 24 months. A wall of paper obligations that was signed, sealed, and delivered when money was free. But money isn't free anymore. And that debt, it's coming due. While the news cycle kept you fixated on the consumer price index or the latest political circus, or the comforting lie of a soft landing, the real money, the institutional capital, was quietly reinforcing the hull. They were preparing for the greatest collateral reset in modern history. You are living inside a mechanical anomaly. The architecture of the American dream, the 30-year fixed-rate mortgage, the white picket fence, the idea of home equity as a savings account is currently being dismantled brick by brick from the inside out. You feel it, don't you? The stagnation, the paralysis. You can't move, you can't sell, you can't buy. You're trapped in the amber of a 3% interest rate, looking out at a world priced at 7%. This isn't an accident. This is a controlled demolition. To understand the trap, you have to ignore the price of the house. The price is a hallucination. You have to look at the plumbing. You have to look at the mechanism. It starts with a concept called duration risk. For 15 years, the Federal Reserve suppressed interest rates to near zero. Banks gorged themselves on long-term debt. They bought mortgage-backed securities, bundles of your loans, and US Treasuries, yielding 1% or 2%. They treated these assets as risk-free. Then the regime changed. Rates spiked. The vertical ascent of the federal funds rate in 2022 and 2023 was the most aggressive tightening cycle in 40 years. Here is the math that creates the nightmare. When interest rates go up, bond prices go down. It is an inverse mechanical law. The bonds sitting in the vaults of major US banks, the collateral underpinning the entire financial system, lost 20, 30, 40% of their market value overnight. These are unrealized losses, a polite accounting term for we are insolvent if anyone checks the books. The banks are sitting on hundreds of billions in paper losses. They are zombies, and zombies need to eat. This is where you enter the equation. This is the $4.2 trillion trap. The banking system needs to reprice its assets. They cannot survive holding 3% paper in a 5% world. They need that old debt extinguished. They need you to sell. They need you to refinance. They need to churn the liquidity. But you aren't selling. This is the lock-in effect. You are holding onto your low rate like a life raft. This has created a liquidity crisis in the housing market. Inventory has vanished. Transaction volume has collapsed to levels not seen since the subprime crisis. So, how do they force the movement? How do they shake the inventory loose? They squeeze the other side of the ledger. They squeeze the labor market. They squeeze the renter. We are watching the yield curve inversion. When short-term rates are higher than long-term rates, the banking system breaks. It becomes unprofitable to lend. The credit contraction begins. Small and regional banks hold 70% of commercial real estate debt. Office towers, apartment complexes, strip malls. These loans are not 30-year fixed, they are balloons. They reset every 5 to 7 years. And the bill is coming due now. Developers who borrowed at 4% are facing refinancing at 9% or 10%. The math doesn't work. The rent rolls don't cover the interest. The equity is vaporized. The keys are being mailed back to the banks. But the banks don't want the keys. The banks want the liquidity. And when they can't get it from the commercial sector, they will come for the residential sector. To understand where this ends, we have to look at 1971. History offers us a receipt. In 1971, the dollar was severed from gold. We moved from a store of value to a store of debt. But the real structural precedent is the Volcker shock of 1980 and the subsequent savings and loan crisis. Over 1,000 banks failed. Why? Because they borrowed short your deposits and lent long your mortgages. When rates rose, they were wiped out. What happened next is the blueprint for today. The government created the Resolution Trust Corporation. They took the bad assets, swept them up, and sold them for pennies on the dollar. Who bought them? Institutional investors, the wealthy, the consolidated elite. every liquidity crisis results in a consolidation of ownership. In 2008, it was the foreclosure crisis. Private equity firms like Blackstone entered the single-family home market for the first time, buying tens of thousands of homes at auction. They turned the American dream into a rental portfolio. Now look at the forward scenario. Project this out 12 to 24 months. The $4.2 trillion wall hits. Regional banks begin to buckle under the weight of bad commercial real estate loans. The FDIC cannot insure everyone. The Treasury will step in, not to save the shareholders, but to facilitate the merger. JP Morgan, Bank of America, Wells Fargo. The giants will absorb the regionals, but here is the darker vector. As the commercial sector implodes, capital will flee to the perceived safety of residential assets. You will see the finalization of the rentership society. The mechanism works like this. 1. High rates force individual buyers out of the market. 2. Prices soften slightly, but not enough for the average worker. 3. Distressed inventory from failing regional banks hits the market in bulk blocks. 4. Institutional capital, sitting on record levels of dry powder. Cash sweeps in. They don't need a mortgage, they pay cash. They don't care about the 7% rate because they aren't borrowing. They are the yield chasers. This is the great wealth transfer. It isn't a crash, it's an acquisition. The narrative you are being fed is that the Federal Reserve is fighting inflation. That is a half-truth. The Federal Reserve is managing the insolvency of the sovereign debt bubble. They are sacrificing the housing market to save the bond market. The spread between the 10-year Treasury and the 3-month Treasury has been inverted for longer than at any point prior to the Great Depression. This is the signal that the plumbing is broken. So what happens to you? If you own a home, you are a prisoner of your rate. You cannot move for a better job. You cannot downsize. You are liquidity starved. If you are renting, you are facing a consolidated landlord class that uses algorithms to fix prices in unison. The housing ladder is being pulled up. It is being replaced by a subscription model. Housing as a service. You will subscribe to your shelter. You will own nothing. And you will be told to be happy about the flexibility. The $4.2 trillion maturity wall is the catalyst. It forces the leverage out of the system. It forces the default. And in a debt-based system, one man's default is another man's acquisition opportunity. The banks know this. They aren't afraid of the crash. They are the architects of the recovery that follows. A recovery where they own the title deeds and you own the monthly payment obligations. The era of the individual homeowner building generational wealth through simple property ownership is closing. It is being fenced off. The trap is set. The trigger has been pulled. We are just waiting for the sound of the gunshot to reach us. History doesn't repeat, but it rhymes.